Hello everyone, and welcome to this session on the cash flow statement, which is chapter 7 in your textbook. Before we do the cash flow statement, let's quickly revise the quiz that we just completed. These were the questions that we were asked in the quiz. As you all know, all of you got the same question, but in different order of the questions appearing on Blackboard for you all, and that is the reason why I did not allow you all to backtrack and go back and review your answers. Anyhow, I have received feedback from you all, and quiz 2 will be very different from quiz 1. Each one of you will definitely get a different set of questions, but to test the same learning objectives. The first question that I asked in the quiz was, which of these would not be considered an internal user of accounting information? The correct answer is the chairman of the ASIC, the Australian Securities Investment Commission. He is an external stakeholder. He is not an internal stakeholder. All the other answers are relating to internal stakeholders. Question number 2. One of the questions that were asked was the content of the management accounting reports is governed by. The correct answer for that is D. There are no specific rules or requirements governing the content of management accounting reports. The next question was a test for distinguishing between an asset and an expense is. The best answer for that would be whether the benefit extends into the next accounting period. That's an asset. If the expense does not extend to the next accounting period, then automatically it will be an expense. Item number 4, or the next item, a machine is purchased for $130,000. It is estimated that it has a useful life of 8 years, and it will be sold for $10,000. Now, using the straight line method, calculate the amount of depreciation to be charged each year of its useful life. So this is the straight line method. Now, using the straight line method, we have to calculate depreciation per annum, per year. So you know the formula for straight line method says, take the cost of the asset, so cost less residual value or scrap value, and divide that by the number of years of useful life. So in this case, the cost is 130,000. Scrap value is 10,000. And the number of years of useful life is 8 years. So 130 minus 10 gives you 120,000. If you divide that by 8, your answer is 15,000. So the correct answer is D, 15,000. Now it is true that most companies, of the 4 answers given, the most appropriate answer is most companies have limited liability. An advantage of the company form of business, again among the 4 answers given, the best answer is its ownership is transferable through the sale of shares. Next question, resources owned by a business are referred to as assets. Retained earnings at the end of a period of time, usually 1 year, is equal to A, B, C, or D. The best answer for that will be retained earnings at the beginning of the period plus profit earned minus dividend paid during the period. That will give you the balance of retained earnings at the end of the year. So C was the most appropriate answer. Next question. Which financial statement must be prepared before others can be completed? In other words, you can't complete another statement without completing this statement first. You can't complete the balance sheet without completing the income statement first. And therefore, the answer to this question is the income statement must be prepared first. Number 10. If total liabilities decreased by 14,000, and owner's equity increased by 6,000, then total assets must be equal to what? The accounting equation says total assets should be equal to total liabilities plus owner's equity. So if total liabilities decrease, so there's a minus 14,000 there, and owner's equity has increased by 6,000, the net result on the opposite side will be minus 14 plus 6. Your assets should have gone up by $8,000. Sorry, there's a minus 14 plus 6. The asset must have gone down by $8,000. So the answer to that will be decrease in assets worth 8,000, so C. Next question. ABC Restaurant started the year with total assets 90,000, total liabilities 40,000. Take note, this is at the start of the year. The question asks us the equity at the end of the year. During the year, the business earned 100,000 in income, 55,000 as expenses, dividend paid 10,000. We need to calculate the equity at the end of the year. Now, to calculate the equity at the end of the year, we need to know what was the equity at the beginning of the year. Again, going back to our accounting equation, total assets should be equal to total liabilities plus owner's equity. So the start of the year, the total assets were 90,000, total liabilities were 40,000. What was equity? Right, so 90,000, take the 40,000 to the opposite side, equity becomes 50,000. So equity at the start was $50,000. So what is the equity at the end? So the question says, what is the equity at the end of the year? Now during the year, what happened? During the year, the business earns income 100,000 and incurred expenses 55,000. Now any income earned belongs to the owner. Any expense paid, the owner has to bear. The difference between income and expense is either a profit or a loss, which the owner, if it's a profit, the owner gets it, he has earned it. If it's a loss, the owner has to bear it. So let's look at what was the profit or loss during the year. So income minus expenses, which is 100,000 minus 55,000, we got a profit of 45,000. So the owner's equity at the beginning, or the start, sorry, equals $50,000. Then during the year, the company has earned a profit of 45,000, which belongs to the owner. So in total, the owner has in the business $95,000, but out of the $95,000, the dividend that is paid to the owner is $10,000. So profit is a plus for the owner, dividend is a minus for the owner. So what's the net result? Plus 50,000, plus 45,000, 95,000, minus 10,000. The owner's equity at the end is $85,000. Next question. Which financial statement is concerned with the enterprise at a point in time? A static statement, the balance sheet. The answer is the balance sheet. Next question. If a car is serviced on 31st May and an invoice is issued, the owner picks up the car on the same day, 31st May. The owner sends a check to the servicing firm on 4th June, and the firm banks the check on 7th June. Income under the accrual concept of accounting should be recognized by the servicing firm on 31st May, 4th June or 7th June or 5th June. Under the accrual concept of accounting, you record as and when the income has been earned or the expense is incurred. In this example, the income is earned as the invoice was issued on the 31st May. So the answer is A, 31st May. Liabilities plus equity should always be equal to, as you know easily, assets. On 14th May, Green Limited sells goods to Gold Limited. So Green is selling to Gold with payment to follow within 60 days. So this is a credit sales for Green. So for Green, it's an account to be received, so it's an account receivable. For Gold, it's an account to be paid, so it's an account payable. But the question asks us, on Green's balance sheet, the amount owed by Gold should be recorded as an account to be received, receivable. The payment of a liability, again, go to the accounting equation. When you pay off a liability, you're paying it in the form of cash. So your cash, which is an asset, decreases, and you're paying off a liability, so your liability also decreases. So the correct answer is decrease in an asset, decrease in a liability. The effect of the accounting equation of the business purchasing a new motor vehicle on credit for 35,500 is, what is happening here is, again go to the accounting equation. In the accounting equation, we are now getting a new asset called motor vehicle. So the motor vehicle's asset will increase. So we look at the answer and we look at wherever we have increase in motor vehicle. Okay, the first one is increase in motor vehicle, the second one is increase in motor vehicle, the third one is increase in motor vehicle. The next part says the cash was not paid, but it was on credit. Since it's on credit, we have incurred a liability, so there should be an increase in an account payable or a liability. So motor vehicles increase by 35,500 and liabilities increase by 35,500. So the best answer is D. The next question. The effect on the accounting equation of the business buying a computer worth $900 but paying $450 in the form of cash, and $450 is to be paid in 30 days time. So we purchased a computer, so my asset will increase. I paid cash, so my asset decreases. I have now incurred a liability, and therefore my liability will increase. So the best answer for 18, this question will be C, increase in an asset called computer, decrease in an asset called cash, increase in a liability called accounts payable. 19, next question. The accounts for XYZ are as follows. You have cash, overdraft, creditors, inventory, accounts receivable, furniture, loan payable, and car. Owner's equity is what? Again, the accounting equation. Total assets should be equal to total liabilities plus equity. So all you have to do now is add up all the assets and add up all the liabilities, and the difference will be equity. So what are all our assets? The first one, cash, is an asset. Bank overdraft is a liability. Creditors, liability. Inventory is an asset. Accounts receivable is an asset. Furniture, asset. Loan payable, liability. Car, my own car, asset. So if I add all the assets, and then if I deduct all the liabilities, my answer will be 2,300. Your total assets will be 31,300 and your total liabilities will be $29,000. And therefore the correct answer is 2,300. When a customer eventually pays for items that have been purchased on credit, the transaction will affect. Now a customer is paying off his dues to me. So since the customer has to pay me, I would have had an account receivable. Account receivable is an asset. Now an account receivable is paying me off the cash, so accounts receivable will go down, and I'm receiving cash, my cash will increase. So this transaction affects accounts receivable and cash, which are two assets. So the answer to this is two assets. All these statements about the balance sheet are true except assets are listed in order of liquidity. Yes. It shows the cash received and cash paid for the period. No, it does not. Why is that so? Because the balance sheet is prepared on the accrual basis, not the cash basis of accounting. In other words, all credit as well as cash transactions are recorded. So the answer to this question is the balance sheet does not show cash received and cash paid. So all the other three items are correct, true. The distinction between current and non-current liabilities is based on which of these is the best answer. Current and non-current, the asset test for that is a period of 12 months. In other words, when the liability is due for payment will be the deciding factor between current and non-current. A truck was purchased for $45,000. Its estimated residual or scrap value is $5,000, but its accumulated depreciation is $10,000. What is its carrying value? Now, the question only asks us about the carrying value. It doesn't ask us about depreciation. Depreciation is already given to us as $10,000. So carrying value is nothing but cost less accumulated depreciation. So the cost was $45,000. Accumulated depreciation is $10,000. So the correct answer is $35,000B. Next question, equity is increased by income. As we all know, equity is increased by income and equity is decreased by expenses and drawings. The question says equity is only increased by income. Which of these is an asset? Income tax payable is a liability, bank loan is a liability, owner's equity is also an internal owing to the owner. It's not an asset, and therefore the correct answer is investments. Overall, the quiz was a real success. Majority of the people have done excellently well, and I must congratulate every one of you. We'll now move on to this week's learning activities. Before we do that, let's do a quick revision of the cash flow statement. The cash flow statement is just like a little seesaw. You have one child sitting on one end and the other child sitting on the other end trying to balance each other. But if you look at a seesaw, the most important part, the strongest part should be this pivot. The central part that holds this entire seesaw together is this red triangle or a pivot. The cash flow statement is very similar. The owner gives cash to the business. There's an inflow of cash from the owner. The owner is a financer, is financing the business. So the financing activities sit on one side of the seesaw. So if the owner gave us $10,000 and I also took a bank loan for $10,000, I have a total amount of finance of $20,000. Now those two are financing activities in the cash flow statement. This $20,000, I can invest it under investing activities in long-term, non-current investments, which are assets. So if I have $20,000 from my finances, I can invest $20,000 in my investments in long-term assets. But to keep the business as a going concern, these investments must be productively used, productive enough to generate income and enough profit to pay off these finances and to keep them happy. So the third part of the cash flow statement is your operating activities. The operating activities use the long-term assets in operations. And these assets are used to generate revenue, which is a plus. But to generate this revenue, we have to meet expenses, which is a minus. So revenue minus expenses in operating activities will result in either profit or loss, which is used to pay the financiers. In other words, the financing activities and the investing activities are continuously balanced by proper operations. Now, what's the key difference between financing, investing, and operations? Financing are long-term activities. Investing are also long-term activities. But operating activities are not long-term, they are short-term recurring activities. Right? We did this in the presentation with the narration, but just a quick review. The cash flow statement, what does it show us? It shows us where the cash came from and where the cash went to and what's the net result. It is prepared on the cash basis of accounting, not the accrual basis of accounting. A quick revision, cash basis and accrual basis of accounting. The accrual system focuses on the time when the transaction takes place, irrespective of the fact whether cash was received or cash was not received. It must be recorded. The cash basis of accounting, on the other hand, records not when the transaction took place, but when the cash was actually received or the cash was actually paid. Why do we need to prepare the cash flow statement? It tells us where the cash came from, all our receipts. It tells us where the cash went to, all our payments. And these cash receipts and payments are captured under three activities, like we saw in the seesaw: operating, investing, and financing. What does the cash flow statement show us? What's the key objective? The key objective is to show us why the beginning balance of cash in the business was different from the closing balance of cash in the business. For example, if the business at the start of the year had $50,000 worth of cash, and at the end of the year it has $125,000 worth of cash, the cash flow statement will show where that extra $75,000 came from during the year. Cash flow statement is important because it enables the business to understand whether it has enough money on a timely basis to meet its commitments. If you look at Microsoft Corporation or say Apple or Cisco Systems or IBM, you will see that most of the time they have accumulated billions of dollars in cash and temporary investments. Microsoft, for example, in one particular year had 60% of their total assets in the form of cash and temporary investments. So that is holding too much of excess cash, and therefore the company had to declare a dividend in the form of cash as a cash payout to its shareholders to the tune of $32 billion. In other words, the cash flow statement is the most important statement because it helps the company understand whether it is having too much of cash or too little cash. Now, what's the asset test, or what's the best level of cash to be kept? There's no right or wrong answer. It all depends on the company, its management, and their vision for the future. The cash flow statement has three activities: operating, investing, financing. They explain why the cash position has changed during the year. Investing activities are long-term. Financing activities are are also long-term, whereas operating activities are the only short-term recurring activities. Let's give ourselves some examples. If the owner gave money to the business, it's a financing activity, it's an inflow of cash to the business. If the business pays dividend to the owner, it's an outflow of cash for the business, but it's a payment back to the financer, and therefore it's a financing activity. Investing activities examples. The business purchased a machine for $10,000. There's an outflow of cash, but the outflow of cash resulted in buying a machine. And therefore, it's a long-term investment in an asset. It's an investing activity. The business has some old computers, and they sell this old computer for $300 scrap value. $300 is a cash inflow to the business, which is a result of a sale of an old asset, and therefore it's an investing activity. In other words, in the three activities, you'll have cash inflows and cash outflows. Operating activities. The business pays salary to its employees. Now, it's an outflow of cash under operating activities. Now, why is it under operations? Because it's short term, it's recurring in nature, it happens again and again and again during the accounting period or the one financial year. The business sells goods on credit. Now, will this go to the cash flow statement? It is an operating activity, it is a recurring activity, it is a short-term activity, but it's a credit sale, and therefore there was no cash inflow. It will not be recorded in the cash flow statement. However, after 2 months, if the debtors or the accounts receivable pay their money to the company, then it's cash coming in according to operating activities from my credit sale in the past. Now that will be captured in the cash flow statement. Now those 3 little bullets will explain what operating, investing and financing activities are and from where they actually come from, which financial statement. There are 2 methods of preparing the cash flow statement, the direct and the indirect method. The direct method is a very straightforward method. The indirect method is where you try to reconcile the profit and show the reader or the stakeholder whether the profit from the income statement is similar to the cash from operations in the cash flow statement. You're trying to reconcile the two to explain why they are different or why they're not different. Now, Australian companies are encouraged to use the direct method and also to prepare the reconciliation. So that was a quick summary of the presentation of the topic that we were supposed to do in week 5. We'll now move on to the learning activities. Now I'm going to put this up on Blackboard for you all. Now you can use this while listening to this echo recording. All right. The first question says, what is the purpose of a cash flow statement? We just now said, what does it do? It shows us the cash receipts and the cash payments and the net effect. In other words, it's explaining why the opening balance of cash was different from the closing balance of cash. It helps the business understand the business's potential to generate cash flows and the ability of the business to meet its financial commitments. Not just that, it also focuses on reporting to the stakeholders how the business is managing its cash. 7.11. What's the difference between the cash and the accrual basis of accounting? We all know that the accrual basis of accounting is trying to match revenues and expenses as and when they happen, where the cash base of accounting matches cash receipts and cash payments. Now those are two simple theory questions. Let's go to a few problems now. 7.16. 3 sisters formed a partnership to sell skincare products made from organic ingredients. They have been operating for 1 year. The bank balance at the end of the year is $41,000. A summary of the business transactions is given to us, and we need to prepare a statement of cash flow. Now what we need to do first is look at each item and categorize them into number one, either operating or investing or financing, and number two, whether there was an actual cash inflow or an actual cash outflow. In other words, it could be an operating activity, it could be an investing activity, it could be a financing activity, but it will not be recorded in the cash flow statement if it did not result in an actual cash movement. Let's take the first one. Sales to customers. Now I sold goods to customers. Now this could be on credit or this could be on cash. It's not told to us, and therefore we can safely assume always that sales is on the basis of credit, and therefore this will not be reported in the cash flow statement, but it will be reported in the income statement, because the income statement uses the accrual base of accounting, the cash flow statement uses the cash base of accounting. So we'll say not in the income statement, not reported in the cash flow statement, but reported only in the income statement. Second one, receipts from customers. So I sold goods to customers previously and now I'm receiving the cash, and therefore this is a cash inflow. And it will go to the cash flow statement under what activities? Since this is receipts from customers, which are a result of sales, it's a recurring transaction, it happens again and again in the business, and therefore it will be reported under operating activities in the cash flow statement. Next one. Payment for inventory. I'm paying for my inventory which I purchased. Now therefore this is also a cash transaction, but I'm paying, and therefore it's a cash outflow, not inflow but outflow. And this cash outflow again is recurring in nature. It could happen again and again during one financial year because you buy inventory, replenish your inventory regularly, and therefore this will also be reported under operating activities in the cash flow statement. Payment for electricity, telephone, rent, insurance. So these are payments and they all pay in the form of cash, and therefore these are cash, not inflows but cash outflows, and these are recurring in nature. They are to be paid every month, and therefore they will be reported under the operating activities. In the cash flow statement. Purchase of motor vehicle. So we're buying a motor vehicle and therefore we have to pay cash unless it's said to us purchased on credit or a bank loan. So this is also a cash transaction, but it's a purchase and therefore it results in a cash outflow. And this cash outflow will be reported under investing activities because this is non-recurring, long-term in nature. Drawings. The drawings are anything in the form of cash, but here we're given as cash 50,000 that the owner has taken out of the business. So this results in a cash outflow, and this cash outflow is money that the company is returning back to the owner. So it's a cash outflow, and this outflow is going back to the financer, and therefore this will be reported under financing activities. the business pays interest. Now this is very tricky. I'll make it very clear. I would like you to follow what I'm trying to say to you all now. If you read the textbook, at times it could be a little bit difficult to understand, but let me explain this to you all. Paying interest, of course this is a cash outflow, we will agree on that, but this cash outflow, under which activity will I report it? Now initially when you look at this, we know that this is money, interest paid to someone who gave us a loan. So generally this is a transaction that affects the financer. The financer gave me a loan, now I'm paying back interest. Now unless I tell you this interest was paid every month, or if I tell you this interest was paid once in 2 years, then you can look at it in terms of short term or long term. But the logic is interest is paid generally every month or every quarter. And therefore it is recurring in nature. It's not just recurring in nature. Where do you get the money from to pay this interest? The money must come from your operations. And therefore cash paid as interest, though it is paid to the financer, it is not paid once in 2 years or once in 3 years. It is paid regularly from your operating revenue. And therefore cash is paid as interest and is recorded under not financing activities but operating activities if it is relating to interest. So cash out under operating activities in the cash flow statement. Loan proceeds. So I took a loan and I got $20,000, and therefore this is a cash inflow. And this cash inflow is from a loan. Now the textbook just says loan proceeds. By right the textbook should tell you loan proceeds from, say, a 5-year loan or a 3-month loan or a 6-year loan. And therefore if it is 5 years or 6 years or 3 years will be subjective, but generally we will take bank loans as long term and therefore they will be categorized under financing activities. Now interest received. Again, this could be a little bit confusing, but I'll try to make it as simple and easy as possible. Now, interest received. Now, when will you receive interest? You will receive interest when someone has taken something from you. For example, if I gave you a bank loan, you will have to pay me interest. And this interest is definitely a cash inflow for me, and therefore it will be a cash inflow. But this cash inflow is coming to me not once in 5 years, not once in 3 years, but regularly every month. And this will go to help me in my operations. And therefore cash received by way of interest is treated under operating activities. Though it looks as if the interest is received from an investment. I gave money, it's like investing my money in someone else, and they are now paying me interest. It is like a return from investments, but since it's recurring in nature, since it goes into helping me in my operations, we have to categorize it under operating activities. Income tax paid. Again, you pay your tax based on your profit, and that is done every year, and therefore this is a cash outflow under regular payouts, operating activities. In the cash flow statement. Equity injection. The owner injected further equity, further capital into the business. So the business is definitely receiving the cash. So there's a cash inflow, and this inflow came from the owner, and therefore it will be reported under financing activities in the cash flow statement. I hope this is clear. I would like you to re-look at this once again to understand the key difference of reporting transactions under operating, investing and financing. Here's a little visual to help you understand this. Okay, operating, investing, financing. Operating, investing, financing. On this side, I have sources or increase in cash or cash inflows. And on the opposite side are uses or decreases in cash or cash outflows. The inflows from operations are receiving money from revenue activities. When I sell goods, I receive cash. That's under operating. When I pay for expenses, it is under operating. Both are recurring in nature, short term. Investing activities. When I sell an old asset, there's an inflow of cash. When I buy a new asset, there's outflow of cash. Investing activities. Financing activities, when owner gives me money, or when I sell a debt security and I get some cash, or when I take a bank loan. Financing activity, there's a source, there's an inflow of cash. Cash increases. But when I pay off my loans, when I pay dividend to the owner, when I pay off a security, they're all outflows of cash under financing. So the two important things under financing activities for us to take note of are, number one, dividend or drawings paid to the owner. Similarly, a company can make an investment and receive dividends. So that could be dividend received. A company has to pay interest on bank loans, and a company may receive interest. So these four items we need to be very clear about. Dividend paid is absolutely simple. It is paid to the owner, who is my financer, and therefore this is always under financing activities in the cash flow statement. And this is a cash outflow. So I'll put a minus there for you all. Cash outflow. Dividend received. It's a cash inflow, but from where are we receiving the dividend? And do we receive this every month or recurring in nature? Dividend received is a receipt of money from an investment. Let's make this more clear. Now I have company A and I have company B. Company A invests in company B $10,000. So company A has invested $10,000 in company B. So the money that company A gives company B, for company A, it's an investment. And for company B, it's a source of finance. So the $10,000 in the cash flow statement of A will be reported under investing activities. And the receipt of $10,000 from financer A will be reported in the cash flow statement in company B as financing activity. Now, after 1 year, company B is paying an amount of dividend of $500 to company A. So for company B, it is dividend paid to the financer, and therefore dividend paid is a financing activity for company B. But for company A, the dividend is received from its investments, and therefore we categorize that under investing activity. When company A invests, it was a minus. For company B, it's a source of finance, so it's a plus. When company B pays dividend, it's a minus, a cash outflow. When company A receives dividend, it's a plus, cash inflow. So dividend paid is financing, dividend received is investing activity. And it's a plus. Interest paid, interest received are something that happen in a recurring nature. It happens again and again, and therefore these two are always operating activities. Dividend, interest paid and interest received, both the operating activities. Interest paid is a cash outflow. Interest received is a cash inflow. So these are the four important items that at times you can be confused with. Again, I repeat, dividend paid is paid to the owner, so it's financing. Dividend received is cash inflow from an investment, and therefore it's investing activity. Interest paid is paid on a regular basis. It's under operating activities, cash outflow. Interest received, again, is received generally on a recurring basis, and therefore it is under operating activities, cash is coming in, so it's cash plus cash inflow. Investing in a company is an investing activity for the person who's investing. For the person who's receiving, it's a financing activity because cash comes in from a financer. Dividend paid, for the company that made the investment, it's a return from an investment, cash inflow, and it is under investing. For the company that pays the dividend, it is a payout of cash to the financer, and therefore it's under financing activity. Revise this and be sure that you get this clearly. If not, come on, collaborate, and I can explain this more clearly to you all. Also remember, in the cash flow statement, only cash transactions are recorded, non-cash transactions are not recorded. Now here are some examples of non-cash transactions. Depreciation. Now what is depreciation? Depreciation is only a charge. It's not an actual payout. Cash is not paid, and therefore depreciation is a good example of a non-cash item. I'll go back to the learning activity exercises now. We'll go to the computer. Right, so this question is a good question, 7.16. Understand it once again before you fill in the blanks in the question. So what we have to do now is take all the operating activities. Wherever we have operating activities, if it's an inflow, it's a plus. If it's an outflow, it's a minus. Let's take the first one we have. We won't report that. Second one is under operating activities, there's an inflow from receipts from our customers, 199,000. So cash flow statement under operating activities, receipts from customers, $199,000. That's the first one. Second one. Outflow under operating activities, payouts for inventory, 103,000. So that's a minus, 103,000. Payout under operating activities for electricity, telephone, insurance, etc., $5,000. Now that's a negative. Under operating activities. Purchase of a motor vehicle, that's a investing activity, and that will go under investing activities. So under investing activity, sorry, took the wrong one out. Change that color. Yep. Investing activities, purchase of a motor vehicle for $30,000. Copy that. Okay. Drawings, financing activity, cash outflow 50,000. So under financing activity, drawings 50,000 is a negative, minus. Purchase of motor vehicle is also a minus, cash outflow. All right. Oh, it's already there. Take it off. Okay. So 50,000 was drawings to the owner. Payment of interest, interest paid. So that's a cash outflow on the operating activities, $8,000. So under operations, 8,000. So under operations, 8,000. It's a minus. We paid interest. Loan proceeds, we got a loan for $20,000, and that again is under financing activities. Now that's a plus because the cash came in from the loan. Interest received, inflow under operating activities, 1,000. Income tax paid, operating activities outflow, so minus 3,000. Owner gave us some more equity, so equity injection 20,000 under financing. Yep, we put all the transactions in under 3 categories. So that's your operating. Investing, financing. Now under operating activities, you add up all the pluses and then you take off all the minuses and see whether your net cash has increased or decreased from operations. So 199,000 minus 103 minus 5 minus 8 plus 1,000 minus 3,000, you should get a net result of $81,000. Now that's your net increase in operating activities cash inflow. Similarly, investing activities, there's only one transaction and therefore the net decrease in investing activities is minus $30,000. Similarly, financing activities, we have minus 50,000 plus 20,000 plus 20,000. So that will give a net result of negative 10,000. So net cash from financing activities is minus 10,000. So plus 81,000 minus 30,000 minus 10,000 will give you your net increase or decrease in cash during the year. So plus 80,000 minus 30,000 minus 10,000 gives you 81 minus 50. No, minus 40 gives you 41,000. So that's your net increase in cash because it's positive. 41,000. Now this 41,000 should be exactly the difference between your opening and closing cash. Now opening cash balance in this question is not given, so it's a 0, and therefore our closing cash balance, which is given as 41,000, our answer is correct. If you look at the question, it says closing cash balance is $41,000. So that's the cash flow statement. Operating, investing, financing activities. Operating, inflows and outflows recurring in nature, short term. Investing activities, inflows and outflows but non-recurring in nature, long term. Financing activities, again cash inflows and outflows, again non-recurring in nature, long term. So that's your entire answer for your statement of cash flows. The next question is 7.18. 7.18. There are a few transactions given to us in the textbook, and 7.18, these are the transactions. I put it down here for you all. Okay, so those are the same transactions which you have to do for A and B. Transaction 1, credit purchases $10,000. The question A says, indicate the effect on the balance sheet categories in the following format. So the first one says credit purchases. The business purchased goods on credit. Now will this go to the cash flow statement? The answer is no. But will it go to the balance sheet? The answer is yes. Will it go to the income statement? Yes. It's credit purchase. So since it's a credit purchase, we have incurred a liability and we have purchased an asset, and therefore the transaction will affect other current assets, not just cash. So that will be a plus 10,000 because we got, say, inventory for 10,000, and there's a current obligation to pay this 10,000, and therefore that's a plus under current liability. Okay, so you have the transaction there, and I'll tell you the answer. Okay, question number 2. Cash paid to suppliers. We paid cash, so therefore there's an outflow of cash, $12,000 minus. But who did we pay? We paid off our suppliers. So since we paid off our suppliers for credit purchases, cash went out and it went to our supplier. So when we paid cash to our suppliers, we would have received inventory. Again, the book is not very clear, right? In the exam, don't expect questions that are not clear. You can expect my questions to be crystal clear. So by right, the book should say cash paid to suppliers for inventory purchased. Right? Or we can say cash paid to suppliers for credit transactions previously. Now if it's for inventory, inventory came in with $12,000 and cash was paid $12,000. Right? Next one, 3. Oops. Credit sales $16,000. Credit sales $16,000. So I sold goods, I have generated income for the owner, but I haven't yet received the money. So this is an account receivable resulting from sales, which is revenue to the owner. So 16,000 will go under other current assets, an account receivable, 16,000. And owner's money increases by 16,000 because of revenue earned. Cost of sales. Now, cost of sales meaning our inventory is used up, our inventory is expensed off, and therefore other current assets will go down. Inventory goes down by $12,000, and this is an expense, and therefore the owner bears that expense of $12,000. Cash payments received on accounts receivable, 16,000. So we received the money, so cash comes in 15,000. And this comes from our account receivable, which is an other current asset, which will go down because the money is now paid off to us. Salaries accrued. Accrued, the word accrued means due but not yet paid. So this is a payable. Since it's a payable, it's a liability. So for sixth transaction, my liabilities increase by $4,000. And this $4,000 is an increase in liability because of salary that is due but not paid. Since it has become due, under the accrual basis of accounting, it is captured as an expense. And therefore, owner's equity goes down by $4,000. 7. Purchased a machine for $2,000 cash. So cash goes down $2,000. My non-current assets increased by $2,000 because the machine came in. Transaction number 8. Depreciation. Expensed $500. Now, as you all know, depreciation is an expense in the income statement, and in the balance sheet, the asset value decreases by that amount of depreciation. And therefore, my non-current assets will go down by depreciation 500, and that depreciation is treated as if it was an expense, and that is $500. Owner's equity goes down. Next one. 9th transaction. Dividend declared. Now, declared meaning not yet paid but to be paid, and therefore dividend declared $950 under transaction number 9. It is declared and it has to be paid, and therefore since it's yet not paid, it's a current liability. So dividend declared $950. And this $950, if it is paid, the owner's equity goes down. Accrual basis of accounting. Since the dividend is declared, even though it's not yet paid, it is accounted for. Rent received $1,000. So rent received in the form of cash, $1,000. So cash goes up by $1,000. And owner's money goes up by $1,000 because we earned that money for the owner. Dividend paid. Dividend paid. Dividend paid, sorry, not 900. Dividend paid is 950 in the textbook. Alright, so 950 dividend paid. So cash is paid for dividend 950, and this 950 is it goes off to offset our previously incurred liability of 950. Lease paid $1,500, so cash goes out $1,500, and this is a lease payment, it's an expense, so owner's equity goes down by $1,500. Again, this is just to re-cement in our minds the accounting equation and how all transactions are recorded, but not all of these transactions will go to the cash flow statement. For example, credit purchases will not go to the cash flow statement. Salaries accrued will not go to the cash flow statement. Depreciation will not go to the cash flow statement. Dividend declared but not yet paid in the form of cash will not go to the cash flow statement. Only those transactions that result in an inflow or an outflow of cash will go to the cash flow statement. The last question we have to do. 7.37. It's a really good question. 7.37. If you have your textbooks, you can open up your textbooks and look at the question. I didn't type it out all over again, but I'll show you quickly in the visualizer. Here we are, 7.37. Okay, given below is information of a sole trader for 31st December 2012. Using the information, we have to prepare a statement of cash flows. Cash balance on 31st December. Now the statement is on 31st December, so that is the closing cash balance, $61,000. The question also gives us the opening cash balance on 1st January, $46,000. So you and I know by right our cash flow statement should explain the difference between the closing cash and the opening cash. So the opening cash was $46,000. The closing cash was $61,000. The difference between these two will be your answer in your cash flow statement. In other words, you can check your own answer to realize whether you got the perfect answer or not. Right? So 46 and 61, the difference is $15,000. And this was at the beginning and this is at the end. So at the beginning I had 46, at the end I have 61. So that means my cash has gone up by 15,000 during the year. So this 15,000 will be explained with the help of operating activities, financing activities, and investing activities. The net result of operating, investing, and financing, the cash inflows and the cash outflows, the net result of these three will be $15,000 in the cash flow statement. Please take note, this is your closing cash, this is your opening cash. So your opening cash plus an additional 15,000 earned from these three activities during the year results in the closing cash of $61,000 at the end of the year. Alright, cash paid to employees and suppliers. Now this is investing, financing, or operating. Now this is recurring in nature. It's a cash outflow under operating activities. Cash received from sale of land. So I sold some of my land and I received cash. Since I sold some of my land, now when I bought the land, it was an investment. When I'm selling the land, it is a sale of my investment. So that's a cash inflow from investing. Cash paid is income tax. I'm paying my tax, recurring in nature, it has to be paid regularly, and therefore this is a cash outflow under operating activities. Cash received from money market borrowings. I'm borrowing money from the money market. They are financing me, and this is a cash inflow under financing activities. Depreciation expense for the period. Now this is a classic example of an expense that is not paid in the form of cash, and therefore this will not go to the cash flow statement. Cash paid to purchase equipment, long-term asset, cash outflow under investing activity. Cash paid as drawings. The drawings means anything that the owner takes out of the business. So we're paying the owner $63,000 cash. Now that is an outflow under financing activities because it's money that goes back to the financer, the owner. Cash received from customers. Now this is a result of credit sales and therefore is recurring in nature. It's an inflow of cash under operating activities. Cash received as dividend, cash received as interest, cash paid for interest. Whenever you see the word interest, whether it's a cash payment or a cash receipt or an inflow or an outflow of cash, it's recurring in nature. Both these will go under operating activities. So let's put all these transactions into the cash flow statement. I'll use the visualizer. So I have a question as well as seven. Yep. Seven. Okay, and I'll use this paper to write it on, so you have the answer there. So that's how you write up the answer. Always write the name of the company and the statement that you're preparing. Statement of cash flows for the year ended 31st December 2012. Now, operating activities, we list all the transactions from operations under operating activities. We'll write the inflows first and then we'll write the outflows. Cash received, cash paid to employees and suppliers, $260,000. Now that's a cash outflow. So cash paid will be an outflow under operating activities. So cash paid to employees, which is $260,000. So that's a minus. You can put a minus sign or you can even put a bracket. Both are all right. Cash received from sale of land. Now that is investing activities, inflow 45,000. So cash from sale of land, that's a plus $45,000. Cash paid as income taxes, $20,000. Income tax paid is operating activities. Cash paid for tax minus $20,000. Cash received from money market borrowings, $30,000. Now we're receiving money from borrowings, so that's a loan, long term, and financing. So under financing activities, cash from borrowings. Cash from borrowings, $30,000. Depreciation expense, $12,000. It's a non-cash transaction, and therefore in your answer, at the end of your answer, I would suggest write down a little note and you say depreciation is a non-cash item and does not go to the cash flow statement. Does not go to the cash flow statement. Write a little note down there at the end of your answer. The cash paid to purchase equipment, $50,000. Cash paid to purchase equipment, $50,000. So cash paid to purchase equipment is under financing, under investing activities because you're buying a long-term asset. So cash paid to purchase equipment. So cash paid to purchase equipment was, what was that? Cash paid to purchase equipment, $50,000. Now that's a minus because you paid cash. It's a cash outflow, $50,000. We'll Opening closing cash will come to later. Cash paid as drawing 63,000. That's money paid to the owner under financing. Cash paid as drawings to the owner minus $63,000. Outflow of cash. Cash received from customers $330,000. Now that's operating inflow of cash. So cash from customers. Cash received from customers $330,000 positive cash inflow. Cash received as interest $8,000. That goes under operating activities. Interest received as cash as well as interest paid. Both are under operating activities. Interest received is $8,000 positive. Excuse me. Interest paid is, how much was that? Interest paid $5,000. Interest paid $5,000 is an outflow of cash. So all the transactions given to us have been recorded in this cash flow statement. Put it all in one little page for you all. Okay, so the statement of cash flow. Operating activities, investing activities, financing activities. The next thing we do is we add up all the operating activities, all the investing activities, and all the financing activities. So if we put all the operating activities together, we will get net cash from operating activities. So minus 260 plus minus 20 plus 330 plus 8,000 minus 5,000 will give you $53,000. You can check it up. And investing activities, sorry, I have it printed there already. Okay, investing activities, you have plus 45,000 minus 50,000, so the net cash is minus 5,000. And financing activities, you have plus 30,000 minus 63,000, so you have minus 33,000 as a net cash from financing. In other words, now you have operating, investing and financing. So 53,000 minus 5,000 minus 33,000 should give you the difference between your opening and closing cash. What was your opening cash at the beginning? At the beginning, the question says the beginning cash was $46,000. And the question says the closing cash at the end of the year was $61,000. In other words, the closing cash is more than the opening cash by how much? That is exactly what we get from operating, investing and financing. So the net increase in cash is $15,000. And how do we get that $15,000? I'll make it bigger. Right? It's plus 53,000 from operations, minus 5,000 from investment activities, minus 33,000 from financing activities will give us $15,000 as the net increase in cash. That 15,000 is nothing but the difference between opening and closing cash. Now this is a very, very good question. It's a practical question. 7.37. If you do not understand any part of 7.37, let me know. I can show you this question once again on Collaborate. I can explain how this is done easily. So those were the learning activities for this session. Yep, we've done all of them. Now, since we are into week 5 and next is week 6, we are almost halfway through the trimester. And with the cash flow statement, we have now completed all the important financial statements in accounting. Next session, next week, next topic will be on doing a post-mortem of the financial statements. Now, as you and I know, the financial statements are prepared based on historical past transactions. In other words, the income statement, the balance sheet, the cash flow statement, the changes, statement of changes in owner's equity, they're all reporting what has already taken place. But any stakeholder will look at what is reported and he needs to go and look beyond the numbers. He needs to do a little investigation. It's just like what we see on television. If you happen to watch CSI or NCSI, crime scene investigation, what do they do there? A crime has taken place, a murder has taken place. The police and the detectives go there and they try to realize, they try to put the pieces together to see exactly what took place, how the murder was committed, what sort of gun was used, where's the wound, what sort of torture this person went through. So CSI shows us, it takes us back to the past to help us reinvent what actually took place. Similarly, in financial statements, what is reported to us by way of the financial statements in the annual report should not be taken as gospel truth. It should be investigated. And therefore, the next topic is analyzing and understanding and interpreting the financial statements, looking beyond the numbers to see the true picture about what has happened in the company. The best example I would like you to take note of is Enron. You saw that little video I showed you, I put up there for you all to see. In Enron, what they do for several years, they were reporting profits. But no one was investigating, no one was analyzing the financial statements. If they had analyzed the financial statements, maybe they would have been able to see the red flags that the financial statements were not truly reporting the actual information of the corporation. So that's what we're going to do next week. We're going to do crime scene investigation of the financial statements. Now, since we are in week 5, moving on to week 6, I'm going to tell you a little story to help you realize what I have been doing and what I expect of you to do for this course. As a young boy, I always wanted to have a talking bird. I would love to go and buy a talking bird and keep it in my home and enjoy listening to it talk. But my father said to me, no, you can't buy it when you're young. You have to be old enough to buy and take care of a talking bird. So when I came up to a certain age, I saved up some money and I went to buy my talking bird. It's just like you're now in a master degree course, and therefore you're off a responsibility now rests upon your shoulders for you to take care of your own affairs, especially since this is an online course. So I bought this talking bird. When I bought this bird, the shop owner told me, now this is the best bird that will talk in the most exquisite manner. So I spent a lot of money and I bought the talking bird. And the man told me, the pet shop owner told me, you need to buy a beautiful cage to keep this bird. So I bought the best exquisite cage, the most expensive cage, put the talking bird in the cage, and I took it home. And at my home, I put it in the most prominent place where everyone who comes to my home can admire my talking bird. It's just like what I'm doing for you in the course. I'm giving you whatever I can, right? We have collaborate, we have narrations, etc. Everything is given to you in a nice package, just like the talking bird. So the package is given to you, you have it in your home now with you. About half a day went by, and I kept looking at the talking bird, and he never spoke a word. He was silent, not even whistling, not even a tune. Something was wrong. So immediately I marched back to the pet shop and I said to the pet shop owner, I bought the most expensive bird, the most expensive cage, and it's still not talking. The shop owner said to me, oh, maybe I should give you another tool. I should give you another piece of advice. I need to give you something more to support you so your bird can talk. It's just like in our course, we just don't give you textbooks. We just don't give you PowerPoint slides. We add on things to help you. So the shop owner told me, maybe you should buy your talking bird a nice mirror. So it can look at itself in the mirror and it can admire itself and it can start talking. So I've given you Collaborate. Collaborate is just like that mirror. You can see me and I can see you via video or audio and we can talk to each other. So I bought this expensive, best possible mirror, took it home, put it opposite the cage and so the bird can look at itself and talk. Did the bird talk? No, it did not. I give you Collaborate and not every one of you want to use it. So we give you tools, but it's all up to you to use. So the bird did not use the mirror. It did not talk. I was so angry. I marched all the way back to the shop owner and I said to him, you gave me the best bird, the best cage, the best mirror. I did all that you told me to do. But the bird's not talking. The shop owner said, oh, I've given you all the tools. I've given you everything you need. Why isn't the bird talking? The shop owner said, oh, let me give you one more piece of advice. Like, say, for example, a video that I put up for you all or something I put up on discussion board like should human resources be treated as assets? We give you the tools. So he said, let me give you one more tool. Let me advise you to buy a nice swing. And then he told me, here's a beautiful swing, very expensive, but buy it for your talking bird. The bird will sit on the swing and will start talking to you. So I paid the money, all my savings gone. I took the swing home, put it in the cage, and I said to the bird, please talk. I bought you the best cage. I bought you the best mirror, the best cage, the best mirror, and now I bought you the best swing. Please talk to me. Sadly, the bird did not talk a single word. In GSPS 6200, they give you all the tools that are necessary. But how to make you talk, how to make you study, how to make you understand things for yourselves. The bird did not talk. I was so angry. I went back to the shop and I almost screamed at the shop owner. It's just like some of us. In our feedback, right? We write things down without realizing what we should have been responsible for. I said to the shop owner, I bought the best bird. You gave me the best bird, the best cage, the best mirror, the best swing. But the bird has not spoken a single word, not even a whimper. The shop owner said to me, I'm sorry, I've done everything I can. I've given you all the advice, I've given you all the tools. But if the bird doesn't talk, something is wrong with you. And then I said, you know what, shop owner? The bird died. The shop owner said, that's a pity. You spent so much of money and the bird did not talk a single word to you. Are you sure it did not say a single word before it passed on? And I said, yes, the bird did say something. The bird said this last sentence before it died. It said, Marcus, you bought me the best cage. You bought me the best mirror. You bought me the best swing. But you did not bring me, or you did not give me, or you did not show me how I can eat my food. You did not give me food. So in other words, friends, I can't give you food. I can give you all the tools to guide you and help you. But you need to look and find ways and means of using those tools by eating from them. GSBS 6200, we are putting in place innovative things, new things to help you. Right? Now, slides with narrations, echo recordings where all the lecture, the summary of the lectures given to you, all the learning activities are explained step by step. Collaborate is a dynamic tool where I can redo all these learning activities with you online, so you can listen to me speaking in real time. So these are the tools that we could give you, but it's up to you to use them. It's up to you to use them to talk to yourselves and to get that high distinction. 85 is easy to get in GSBS 6200. If not 85, you can even aim for 100. Learning is all about exploring knowledge. It's all about engaging your minds. It's all about unleashing the potential within each one of you. That's what I'm trying to do. That's what I'm trying to motivate you. You can do it. You don't have to be in a lecture theater. You don't have to be face to face with me. And yet you can excel much, much better than even my face to face students. I want to challenge you to exceed, transcend those boundaries, right? See beyond work commitments, family commitments, etc. Prioritize your time. You need to take care of your family. You need to take care of your job. You also need to take care of the fact that you have invested money in this course, and you need to get back a solid return. Create new horizons for yourselves. Shoot me questions anytime you need any help, because I believe learning is a journey. It's a journey of empowerment. And this empowerment should help you translate understanding as well as experience into not just a reward, not just a pass in GSBS 6200, not just 50 marks, but into a positive and a fulfilling future. And that positive and fulfilling future in GSBS 6200 should be nothing less than 85% and above. The talking bird story, I always use it to show learners. I'm a learner. I learn things every day. We need to use the tools. We need to use them productively. We need to use them to the best of our abilities as much as we can to get value for money. It's like taking blood out of stone. You put your money in course GSBS 6200, get your rewards. I can only take the horse to the water, but the horse should drink for itself. Thank you, my friends. I'll talk to you again shortly, but we can always talk on Collaborate anytime. Just let me know when you need me to come to log on to Collaborate, to have a chat with you via video or chat or text messages. I can even show you Excel spreadsheets, etc., how I can use them. Since we have some more minutes left of this recording, I'll try to quickly show you Collaborate so everyone can see what Collaborate can do. Just go home. Right, on the course documents, you can see all the material that I've put up there for you all. That's Collaborate. Okay, the first step is to just cut and paste this. This is the screen that will come up. Then you put in your name. Then you go into login. Just allow this to happen. The same screen I've given you here, and this is what is happening. Then you click on run. Accept. Okay, there you are. You're into Collaborate, right? There's video as well as audio. If you want video, click on video. Oh, that's good, someone is online. I'm going to show you now. I hope Alex will reply. If Alex is online. Oh, she just went offline. What a pity. But if you see, oops, sorry, I wasn't showing that. Oh, sorry, I forgot to toggle the screen. I'll redo it again for you all. So Collaborate, you click on that. It'll open this page. You cut this step 1 and you post it into a web page. I'll redo it again because I didn't show the screen. I'm sorry. Do you want to leave the session? Okay. Okay. Paste it in a new URL. Then put your name in there. Login. Just wait for a few seconds. Click on run. You're into Collaborate now. Okay, now that's me. If I want to talk, I'll just click on the talk button and you can hear me talk. If you want to talk, you click on the talk button and I can hear you talk. If you want to have video, you click on video. In this computer I'm using the lecture theatre, there's no video camera, but if there's a video camera, you'll see me up there. Okay. Now I'm just showing you something. There's something called application sharing. So if I want to do something here, for example, I want to draw and say this is how, or this is the accounting equation. Now as I'm talking and explain what the accounting equation is, and you can go step by step with me understanding any question or any exercise that you have. So Collaborate is a good tool. Please start using it to your benefit. Thank you very much. I'll see you soon.